Hi everyone, welcome to today's video. So let me start today's video by showing you a very interesting chart and an observation. So this is a graphic about Sri Lanka's foreign reserve, and if you take a look, the forex for Sri Lanka started declining quite aggressively over the last several years. Then what ended up happening in the Sri Lankan economy? These are some of the scenes that depicts the picture that there were people on the road rolling politicians' car into the river just to vent out the anger because the Sri Lankan economy went bankrupt. Now let me show you second graphic. So this is the forex reserve data for India, and you will again notice that the forex reserve for India has been coming down quite aggressively. So is a similar situation like Sri Lanka will happen in India also? Should you be worried? Should you not be worried? What type of investment decisions you should be making given this decrease in forex situation? That is precisely what we are going to speak about. Also, a very quick shout out to our sponsors for today, which is Wint Wealth. It is an excellent bond investing platform. Usually what is happening is that fixed deposits are giving very low or in fact negative returns in real terms. Equity markets are getting very volatile. In the middle, there is a bond market. So in case you want to take some positions in bond, do check out well-curated bonds from Wint Wealth. So you can check the links in the description box. So in order to understand whether India is going the Sri Lanka's way, it is important to pick up the point what Forex is and what is the current situation of Forex reserves in India. So let me, in very easy to understand language, help you understand what Forex reserve actually means. So Forex reserve, if you simplify the definition, it means this, that this is liquid currency that can be paid to other countries. This is a very important non-technical definition of Forex reserve. What it simply says is that let's imagine a scenario that there is a lot of turmoil in India and there is a lot of macroeconomic risk associated with India. Now, a lot of foreign players might not want to accept INR. They would be okay accepting US dollar or gold or a bunch of other different foreign currencies which India holds. But they would not like to accept INR if a situation of volatility exists in India compared to other parts of the world. So that is the primary value add of having this liquid currency that can be sent to other countries for a series of different reasons. So for example, let's say that India is looking to procure oil from Saudi Arabia and there is turmoil in India. So Saudi Arabia would say that, you know what, we don't want to accept payment in INR, we want it in some kind of foreign currency. So that is where your Forex reserve becomes very, very important. They can help you handle macroeconomic stress. It can also act as an indicator that your economy is resilient. It is fine. It has the capability to bear a lot of shocks. And RBI also use these Forex reserve for a bunch of other different purposes. For example, strengthening our currency, weakening our currency, and the uses of Forex reserve is limitless. Now comes the important point that what is the current situation of Forex in India? Is it really going down? So the answer is yes, it is going down. And if you take a look at this data point, it categorically says that in September of 2021, we had a Forex reserve of roughly $650 billion. Now it has come down quite sharply to roughly $600 billion. So we have cut down our Forex reserve by 7 to 9%. So this is a sharp fall, no doubt about that. Now comes the second key question, that is it worrisome? Will India go the Sri Lanka way? So let us start having a quick discussion around that point. So in order to understand this story better, you need to know two specific data points. So first and foremost, you need to understand what India's Forex reserves are made out of. And it comprises of three things. So first and foremost, we have foreign currency assets. So these would be things like US dollar, Japanese yen, British pounds, etc. So this is foreign currency asset. Currencies denominated in other countries' currency. Second is gold, that RBI purchases a lot of gold and it keeps it in its locker. Third and finally, we have something called as special drawing rights, which is a flexibility that is given by IMF to all the member countries of IMF. And what these special drawing rights are, I will explain that in a few minutes. But to understand whether India is going Sri Lanka's way, you need to know how the Forex reserves in India have transpired over the last few years. So the word of the day today is transpired. Let me know what does that mean. So if you take a look at this chart, what you will categorically see is that in the last 1.5 years, the situation has been very aggressive. For example, in March of 2020, we were sitting on a foreign reserve or total Forex reserve of $470 billion. Then we pumped it up to approximately $650 billion. And now we are bringing that number down to approximately 600 billion as of now. So to cut the long story short, the situation does not look worrying as of now. But let us also understand this as to why our Forex reserve went so high during 2020. So there are three specific reasons for that. So first and foremost reason is that India is a net importer of oil. And in 2020, during COVID crisis, the oil prices got shocked. So oil prices actually came down because the economy was not moving. And you can see this from this chart as well, that the oil prices got crushed. And during that time, India saved a lot of money because it did not have to foot a lot of bill in terms of its oil imports. Now, the second key reason for the fast growth of foreign reserves was very simple, that a lot of foreign based investments started coming in India in USD, British pounds, etc. And we had record amount of investments in 2020. For example, you can check this number. This number has been nowhere close if you look at the last one decade. In 2020, India ended up getting roughly $21.5 billion worth of investment. And if you compare it to any other year, it had never been so high. And that definitely helped our foreign reserves to go up. Now, third and final point is that India is a net importer of things, not just oil, but a series of other different things. And because the economy came to a halt in 2020, India did not have to import much. Now, this is evident through this particular chart. If you take a look at this, 2020 was a year when India's current account deficit, which means exports minus imports, that actually turned positive. And we have never seen such a scenario playing out recently. So to cut the long story short, 2020 from a forex reserve build-up point of view in India was a very impressive year. Now things are getting back to normal, so to say. So in a way, India is cutting down on its foreign reserve. So if you read the news that, you know what, India is going to get bankrupt because India's forex reserves are getting crushed, no, that is not going to happen. At least you need to understand the backstory that I just painted for you. But a related question that you might have for me is that, okay, why is it that our foreign reserves are coming down sharply? Okay, it's one area or one angle that if the reserves are being gradually declined, but why the sharp decrease? The reason is both choice and necessity, that if you understand the macroeconomics as of now, it's very evident that the oil shock has happened. The oil prices are escalating, power prices are escalating, exports of different commodities are escalating due to supply chain disruptions. Second key point, the economies are trying to expand, so they are undertaking a lot of capital expenditure. So we need more money there from that perspective. Third is that our foreign investments have dried up. They have literally dried up as of now. Not a very good situation compared to 2020, 2021. In 2022, the amount of money through foreign investors have been very, very low in India. So as a result, the forex reserves in India have come down quite sharply. On a related note, this is just a GK oriented point, so feel free to skip. I'll quickly tell you what SDR or special drawing rights are. Probably I'll take a minute to just quickly explain through it. And this is a very good graphic that can help you get a grasp on this topic. So SDR or special drawing rights are international reserve assets created by IMF to supplement the official reserves of member currencies. The value of SDR is based on the basket of currencies. So this is the most important point, if just for GK, that if someone asks you what SDR is, it's a combination of different currencies. It gets a certain data point and it can be used by certain member countries. If India, which is a member country of IMF, wants to pay US, which is also a member country of IMF, in SDR, then it can do so. So what is the primary advantage of SDR? Honestly speaking, not much, but since this is a combination of different currencies, it just lowers the volatility of SDR compared to just individual currency. For example, US dollar can move quite aggressively, but SDR is like a mutual fund of different currencies. So this is likely to move less compared to US dollar given the market dynamics. So I hope that gave you clarity on SDR. So let us wrap the final section by talking about two specific points. One is that what would be the risk profile with the foreign reserves of India going down? And second, how you can use that knowledge to make money in the stock market. Should you be worried? Should you not be worrying? And how you should be leveraging this position. So there are three key specific points that you should know. So first and foremost, too much forex reserve is bad for a nation. For example, if a nation holds a lot of currency, then it can technically destabilize the other country, and both the countries are unlikely to coordinate on trade and bunch of other things. A classic case in point is the US-China example, that China ended up holding US dollars in bulk. And as a result, US started looking at China with more suspicion, and the relationship between US and China blew up, so to say, from 2016 onward, and it has been on a downward spiral path. So if it happens that India also starts aggregating a lot of US dollar, then the US will not look at it favorably. Now, here is a news clipping from 2020 outlining this point, that India was somewhat warned by IMF not to aggregate too many US dollars. Now, the second key point is that too less forex reserve is also a bad situation for any country because it can get destabilized internally due to lack of forex reserve. Again, an example could be built from India itself, that back in late 80s, early 90s, India was undergoing a balance of payment crisis. We had an undergoing debt crisis. Our forex reserve were very low, and due to debt crisis, due to lack of forex reserve, countries not showing faith on India, India had to go to IMF to get its loan restructured. And it is only after that from 1991 onwards, India started adopting LPG reforms. So that was a forced step from IMF, that when India went to IMF to restructure its loans, IMF said that, you know what, you need to open up your economy, only then we will extend your loan. So India had to do that after obligation, and in the hindsight, it worked wonderfully well for India. Now comes the third and final point, which is the contemporary risk right now, which leads to de-dollarization of the world. So you might have seen that the US dollar is losing value. Indian rupee compared to dollar is losing value faster. So there is a race going on that which currency will get deflated faster. Now this is a very worrying sign for a country like India, because right now we are more aligned with the US. Unfortunately, the Russia-China camp, that is gaining more and more prominence with time. And at one stage, we are definitely going to reach a point where Chinese will tip over something like US, and that will lead to a lot of problems even for a country like India. I'll probably make a separate video if there is enough interest from all of you analyzing this situation more. But to cut the long story short, this third point is something of a very worrying factor, which brings me to the final section as to what you should be doing about this entire de-dollarization thing, about India's forex reserves going low. What is it that you should be considering? So first and foremost, please do not stop investing, because both INR and USD are losing value like crazy. If you're keeping your money simply in savings account or fixed deposits, you are losing crazy amount of money. There is absolutely no doubt there. A related point here would be that, okay, I want to go to safe options. Which options could I potentially explore? Just please go and invest in bonds. If you don't understand much, bonds are relatively safer. You could consider checking Wint Wealth, but at least you are getting slightly higher than inflation returns. Second key point, please be diversified. I keep on giving the same message every time to show consistency, that all the data points that I aggregate and present to you, there is a theme going on. It's not as if that every new video I'll change my tune, that, you know what, after today's video, do not diversify. I am a diversified investor, so I would say that please diversify across different asset classes, across different countries. That is the most sensible thing to do as of now. Third and finally, please keep a check on this de-dollarization of the world. This is a major tipping point, not only for the US economy, but also for emerging economies like India, because this is going to define the next 20-30 years, whoever runs the economic engine of the world. So from that perspective, be a diversified investor. That is a simple message. Please do not worry about the India's forex reserve situation. It is pretty much in control, but definitely do worry about the de-dollarization of the world. I hope you enjoyed the video. I will see you tomorrow.